What are mergers and acquisitions from the perspective of strategic planning? How can you prepare your strategy for an M&A deal and establish internal controls to facilitate the acquisition process? Hello, my name is Alexis Savkin, and I am the CEO of BC Designer, a platform for strategic planning. In this video, we'll discuss two directions to consider in the context of M&A strategy. What are those two directions to consider for M&A strategy? One, ensure clarity in your own strategy, and two, introduce controls to track the M&A process. And to illustrate these aspects of M&A strategy, I'm going to use the XYZ Eco Group, a company dedicated to creating green areas that we often use as an example. And this company decided to acquire another company, a company that is dedicated to vertical farms. Why they decided to do so and how to implement M&A strategy in this case, that's what we're going to find out right now. So the first recommendation is ensuring clarity in your existing strategy, and it is actually consists of these three parts. The first one is decomposition of high-level objectives. What does it mean? It means that we need to understand our own strategy, and we need to have it in some tangible format. It's not enough just to formulate mission statement and expect that everyone understands it. We need to be specific. That's what we talk about in our strategy implementation system and all other materials on our website. Strategy well described is much easier to implement and much easier to execute, and you can expect it to be more effective. In the case of Eco Group, they did it, and we discussed it in a different video how they did it. So basically, they have this master plan, the strategy for their parent company, and they also have sub-strategies for one of their subsidiaries. In this case, it's one subsidiary that is developing the technology and another subsidiary that is actually implementing this technology in practice, creating green areas. They also have many supporting scorecards, like in this case, one for quality management, another for strategic analysis that includes stakeholder analysis of external factors. There were some scorecards for risk management, for innovation. So I will not talk about this because the strategy of XY, that Eco Group, is well described. Again, in another video, you'll find some explanation, steps that we followed to describe the strategy. What's interesting here is this aspect of working with the stakeholders. What happened in a case of Eco Group when they were working with the stakeholders? So this one is the scorecard for the stakeholders. And as you can see, it's quite detailed. We have here a number of internal, external stakeholders. And if I open any of them, I will find their strategic ambitions. I will find their metrics that I use to quantify the value that we create for the for this type of stakeholders. Actually, this metric is aligned with another scorecard, so it's live data, and there are also some risk identified as well. So, what noticed the management of Eco Group? They noticed that among their clients, there is a group of clients that are potentially interested in their technology, but they will not buy it. These clients were identified as restaurants and hotels. Why restaurants would not buy? Because simply they don't have any reason for this. They are not construction company that actually creates residential complex, residential buildings. A typical restaurant is quite a small business, and there is no reason to invest in green areas, with one exception. They are interested in vertical farms. The technology of vertical farms is very similar to the technology that was used by Eco Group for creating green areas, but the business model is completely different. So the vertical farms are focused on not just creating green spaces, but actually on producing some fresh vegetables and fruits. And it looked like a good match for the Eco Group because acquiring such a company would be beneficial for certain stakeholders that they were not able to satisfy with existing product. So restaurants were in the target group, and hotels as well. So hotels, they were investing in green areas. They were investing in these technologies, but there was no specific demand for public green areas. Yeah? And it was felt like the demand in general from hotels could be higher. So with this rationale, the Eco Group, they found a potential deal to work on, a potential acquisition deal, which was actually a company for that was dedicating to vertical farms. And looking at the interests of other stakeholders, in this case, looking at the interests of investors, they actually understood that there is no contradiction with what investors want. And this was reflected here. I selected investors, and on context tab, I see that it relates to this one. This scorecard is M&A vertical farms, is a scorecard where we develop this strategy. And there is a goal, diversify income. So basically, this potential achievement of this M&A deal is something that investors were interested in. Not just getting income, not just getting revenue from the main business of the group, creating green areas, but also to scaling, to accessing other stakeholders, accessing other customers, and basically increasing market share in different markets as well. So that was perfectly aligned. This idea was perfectly aligned with the investors. And what about local governments? What they have noticed, that, and they have mapped in this way, that potentially it might be dangerous it might create risk for relationship between the group and the local governments, because the group was using the funding from local governments. It was tied to creating green spaces. But in this case, this vertical farm is not a green space, not public accessible green space. So it could be a challenge. But there was an idea that this should be presented as not as a public green space, but as an opportunity to reduce CO2. Because of if you produce food, if you produce vegetables and fruits locally, you basically avoid a lot of unnecessary CO2 emission, avoid this footprint for because of transportation. So that's what the interest of the stakeholder that they have analyzed. And again, I can see here that this what is its rationale? This reasoning behind the interests of this stakeholder is aligned with one of the goals on the M&A strategy scorecard that we'll get back later. So that's what happened in the case of stakeholder analysis of Eco Group. And that's what I suggest everyone to do. Follow similar steps, understand what their current stakeholders need, like we did for local governments, like we did for investors, and also think about new potential clients like hotel and restaurants in this case. So that was a preparatory step. And the final step to ensure clarity in your existing strategy is to actually define the goals, the objectives of this M&A deal. For this purpose, company created this dedicated M&A scorecard for vertical farms. Here I have it in my strategy workspace. Yeah, by the way, you can log into this account as a view user and check out everything yourself to play with these scorecards. Um, so that's how they identify the objectives of this possible M&A with vertical farm. Diversify income. Yeah, so it was clear that the idea was to get access to new segments like restaurants and hotels where they were underrepresented. They also wanted to position themselves as an innovative company that integrate various value propositions. Yeah? So if there is a client who requires both the green area and the vertical farm, they could serve these type of clients. But at the same time, what they wanted to do, another objective of M&A deal, is to keep existing customers satisfied. Yeah, because if you add something to a company, add something to your offer, you might lose contact with your existing clients and not be able to satisfy their needs so well as you did before. So that was on their radars as well. From the viewpoint of technology, of course, the company that was that was creating these vertical farms, their technology was better. The technology was better because simply for producing vegetables and fruits, you need a little bit more advanced technology. So the idea was to integrate this technology in green areas in their main business, and basically other things related to economies of scale. Yeah, so the supply the raw materials in both cases for both organization, for parent company and for new acquisition, they shared some materials, so optimizing supply chain. And from the marketing point of view, it was necessary to present this offer to the customers to showcase that basically they have not just green areas offer, but also had this new offer in terms of creating vertical farms. Knowledge sharing, architecture, talent retention, uh, economies of scale in terms of compliance alignment. All these goals were mapped, and later they were developed with some more controls. Now, the company was ready for the M&A deal, and they started working it on this scorecard, adding some more details. One of the recommendations that we have here is to create scorecards with possible scenarios. You can create it as a separate scorecard, but in this case, we did it for inside this scorecard. Actually, I have it here on my map. Below, I have this section that are the scenarios. So, what are the scenarios in this case? To understand, to create a model for scenarios, basically we used these two parameters. One parameter is the costs associated with the switching to new technology, with doing it on scale. Because the company that was acquired, it's more about technology, about expertise, but they were not doing it on scale. So to do it on scale, there are certain costs related to training, to quality control. The company estimated this cost as $200, and that was on the cost side. On the profit side, there was average profit per customer per year. So about 15K dollars. Again, that's very basic model, but for the purpose of showcasing the idea, I think it's perfectly fine. Using this model, the company created several scenarios. The scenario in this case was really simple. One parameter was number of existing customers that were adopting vertical farming. So basically, the idea was to contact existing customers that were customers require the green areas and suggest expanding the offer by vertical farms. And there was time to profitability metric that is actually calculated using this simple formula. So costs divided by average profit per customer per year multiplied by customers. So basically, we wanted to find out how fast the company is getting its money back. In the positive scenario, when we get 14 of existing customers, we expected to generate required to get to profitability in less than 1 year. Neutral scenario is 7 customers, and negative scenario is just 3 customers. So this basic scenario planning gave us an idea about the number of customers we need to have to be profitable. And we also established a target of profitability to be 2 years. So here I see that the progress is more than 100% because we actually achieved this target faster than 2 years. In this case, it's about 100% the progress because we achieve the time to profitability in it is 2 years. And here respectively it's negative. And also this scenario planning exercise helped us to identify certain risks. What we did, we started doing an interview with the clients to understand if we are actually they're interested in this. Yeah, we don't have to wait for acquisition of the company to find out the position of the clients. It's better to do interview beforehand to find out what the possible challenges are. And it was identified that there is a challenge. And this challenge was let me move it here. This challenge was the challenge of upfront financing. You can see on this diagram on the right how it was quantified. The likelihood of this challenge is high and the impact is high. And it makes sense. For a restaurant or even for a hotel, paying for a vertical farm upfront is something that is not in their budget. So they most likely they will not do this. And most likely they will not accept the deal. And what can we do about this? Again, during interviews, during analysis, it was defined that probably if we'll present it as a leasing offer and we'll partner with some banks or financial organization to provide affordable leasing plans, it will be more understandable by the potential clients. And I will switch this date and please look at this diagram here. You will see how the risk estimation changed. So by the March, we achieved the level of green acceptable risk for the clients. And respectively, I can see if I change this chart, I can see that the number of clients who were interested in signing up for this deal for vertical farm, potentially interested, of course, has increased. So that was the probably the main takeaway of this scenario planning exercise. We did We thought about the scenarios and we thought about possible risks, and we did some analysis. We contacted customers, so we understood what the main pain point is, and we managed to mitigate it. So scenario planning, that's what was recommended to do here, and we did it. And now the main part, because when we define the objectives of the M&A deal, it's just a starting point. We need to make sure that these objectives are effectively implemented. And how to do it? We can implement a number of internal controls. Again, on this diagram, we recommend to do it in a different scorecards, but it depends on the scale. Sometimes you just do it in the same scorecard. And in this case, these controls were implemented right here. So we can use a visual picture, or I can also open some data here. So for example, the control for diversification goal. Yeah, there are two lagging indicators that tells me if we're actually achieving our financial goal of diversification. So there is, for this indicator, for this control, there is a certain plan. I have targets for the end of each month, the percentage, the growth rate among hotel segment, and I have this plan, and we can track it on monthly basis. Yeah, and the same for restaurant rate, you also have it. For customers, we have, again, there is certain control that helps us to look at the percentage of the customers who are actually adopting the integration offer. And for technology integration, so technology integration is quite a vague goal, and we have to make it more specific by using these controls or KPIs. And we were tracking the percentage of services that were using shared APIs, because both organizations were heavily aligned with the IT infrastructure. And we also have some leading indicators here. Leading, I see that's green rectangle. So one of the leading indicator, one of the leading control is to train employees on IT standards that are going to use. And there are more leading indicators, but they're actually coming from the perspectives that we have below. Yeah, so I can see, for example, that this share knowledge and technology and this talent retention, they are leading factors for technology integration. And for all these objectives, we have defined certain controls, big or small, like, for example, for sharing knowledge and technology, there is post-training assessment, there is training, there is number of joint products that we track. So in this way, we're trying to quantify if we're actually sharing knowledge between companies. For talent retention, cultural audit. So with quite a work initiative that would help company to understand if there are gaps between the culture, parent company and new company, and what to do about this. General metric, percentage of people trained. Yeah, regulatory compliance and alignment. Again, more controls to make sure that we actually implement on what we have planned. Yeah? So if we unify the regulatory practices, we need to make sure that the facilities where the vertical farms are installed, where the green spaces are installed, that they actually passed the compliance audit. So we do all the things. Below is scenarios. I visualize them on the map as well. So that's the idea of the controls. And when establishing this, you remember on the first step, we discussed that the stakeholders, they are related to certain offers, to certain controls, to certain metrics, to certain goals. And in this case, for example, I see that integrated product offering is related to one of the items in the stakeholder analysis, which is basically M&A with vertical firms, is this one. So the logic here is clear. That's what we talked about before, that for the product offering, we need to reflect the needs of different stakeholders. And specifically for the local governments, we need to explain how this vertical garden think, what vertical farms think is helping with the public goals. So basically, the idea was that it helps to reduce footprint because the transportation costs are zero, almost zero, and this way we're reducing footprint. So that's a way to install the controls. And there is another part: conduct a cultural audit and implement integration training programs. Again, in this case, in this example, we did it right here. So you will find it certain initiatives for cultural audit, for training programs, and all these related things that you can track. A final touch. Here we have a visual picture of a strategy. Yeah, our objectives, our metrics, our controls, our initiatives, the connection between them. But it also makes sense to visualize all this on the dashboard. And we did it here. So on the dashboard, it's fully customizable. We put the core metrics that we want to track. For example, the growth rate among hotel segment. I see our targets. I see our targets with some stagnation October, and I see how we're doing. I see how the risk was changing. Again, if I switch between the dates, I see actually how it's I see it in dynamic. I also see here the scenarios visualized. For example, the number of existing customers. The positive scenario is that here when 14 of customers of existing customers say that okay, we want to have this vertical farm as well. So visualizing scenarios, visualizing some other metrics, visualizing some of the risk mitigation initiatives. So that was the quick introduction into how we can set up a strategy for an M&A deal. The decomposition, describing our own strategy, defining objectives for acquisition that we have here visually on the map in the scorecard, analyzing stakeholders. It's one of the scorecards in the strategy workspace. Then creating scenarios, what we did in this scenario tab when we analyze the scenarios, use some formula to calculate them, and of course analyze relevant risks. Then creating internal controls, all these metrics, all these initiatives inside that help us to execute these goals and make sure that we are on the right track, including this dashboard that is a kind of visual control. And of course, not forget to include in all these the cultural thing, the cultural audit or integrated the team, the internal controls that would help us to do this. That's what we have in under the talent retention and under share knowledge objectives on the scorecard. I invite you to sign up with a free plan of BC Designer. I invite you to visit this scorecard with this account as a view-only user to have a look at it. And as always, feel free to share your insights, your ideas about M&A strategy, about the nuances of preparing for M&A in the comments below the article or below the video. Thank you.